Welcome to the deep dive. Today, we're embarking on a journey, really, into something quite profound, often kind of hidden, but it's a revolution that's rapidly reshaping, well, global trade as we know it.
Hmm.
At its heart, there's this central escalating tension. The United States implementing increasingly robust tariffs on Chinese goods, and then China's equally strategic, multi-pronged response. They're rerouting their vast exports, cultivating entirely new markets.
Yeah, it's a fascinating economic chess match, isn't it? Playing out right now in real time.
Exactly.
And it's not just about, like, abstract economic ideas or trade deficits on paper. This is a direct result of geopolitical pressures. These
Right.
pressures, they're not just putting up barriers, they're also, quite surprisingly, forging these new, sometimes innovative, sometimes frankly controversial pathways for goods around the globe.
Right.
So our deep dive today, we're going to really try and unravel how Chinese exports are navigating these, let's say, turbulent waters. We'll be looking specifically at that strategic pivot towards Southeast Asia and India.
That pivot seems key.
It really is.
Yeah.
And how this is leading to some really dynamic, sometimes challenging shifts for economies right across Asia. You'll hear about, everything from bustling ports in Vietnam to Apple setting up huge manufacturing hubs in India.
And to really get our heads around this intricate picture, we haven't just relied on, one perspective. We've pulled from a really rich stack of sources.
Hmm.
We've got granular customs records. They show us exactly where the goods are moving. We've got in-depth economic analyses giving us that bigger picture, and even, vivid regional news reports from right across Asia.
Yeah, it's a confluence of insights, really, not just one viewpoint. And the aim is to give you, our listeners, the most comprehensive, sort of nuanced understanding possible.
We're basically trying to give you the shortcut to being genuinely well-informed on this.
Exactly. Our mission for this deep dive is to offer you that direct path. We're sifting through all this info, trying to pull out the most important nuggets of knowledge, the key insights. Not just the what, but the critical how and why behind these really significant, unprecedented shifts in global trade.
Yeah, we want you to walk away with a clear picture of how these global supply chains are being fundamentally rewired right now.
Okay?
All right, let's unpack this then. The absolute core issue driving this massive global economic reshuffle is, well, undeniably the escalating trade friction, particularly between the U.S. and China. We've been watching this for years, haven't we?
We have, but what we're seeing now, it really does feel like a profound escalation. Almost like a full-blown economic showdown. And the U.S. stance has been made incredibly clear. President Donald Trump's concern proposal, we're talking substantial 55% tariffs
Yeah.
on a really broad spectrum of Chinese products.
55%, that's huge.
It is. And notably, it includes critical things like electronics. This isn't just, a negotiating tactic anymore. It feels like a very real, very high-stakes policy direction the U.S. is actively pursuing. It's a clear signal.
And when you look at the stated U.S. rationale behind it, it's kind of multifaceted, isn't it? It draws on this narrative of their own domestic economic challenges.
That's the justification, yes.
Yeah.
They cite concerns over what they perceive as, a relative decline in the competitiveness of key U.S. industries.
Right.
They talk about widening inequality within the U.S. and what they describe as, insufficient job creation. The underlying idea, at least from their perspective, seems to be that these tariffs will somehow fix those deep-seated domestic economic issues.
Bring jobs back, bring manufacturing back, the America First policy really playing out.
Exactly. But what's truly fascinating here, I think, is how these tariffs represent more than just a simple trade barrier. They're part of a broader protectionist practice, rooted in a very specific economic philosophy. And the research, from places like the Tax Foundation and others, it suggests that while maybe permanent import tariffs might, at best, have only a modest impact on reducing trade deficits,
Yeah.
their actual effectiveness is, well, highly debatable.
Right. Modest impact at best.
At best. And here's the really critical part. If these tariffs, especially if they're seen as temporary or politically motivated, if they're met with retaliation from trading partners, which, let's face it, often happens,
Almost always.
yeah, they can actually trigger wider economic downturns,
Mhm.
potentially even recessions. So it's a strategy that's really fraught with risks. It could end up harming everyone involved, not just the country being targeted.
And this uncertainty, you can actually see it in the data, can't you?
Oh, absolutely. It's vividly illustrated by Macromicro's Trade Policy Uncertainty Index. This index, it basically measures how much economic policy is kind of up in the air. In April, it surged to nearly 10 times its level from just last September.
10 times. That's not just a number on a chart. It's a clear indicator of just how unpredictable and volatile these trade dynamics have become for businesses, trying to make long-term investment decisions. It makes planning incredibly difficult.
Okay, so that's the pressure from the U.S. side.
Yeah.
But here's where, for me, it gets really interesting. China's response. It isn't about just hunkering down, is it? Or just weathering the storm.
Not at all.
They seem to be strategically redirecting their entire economic might. They're not just reacting, they're actively, maybe even aggressively, reshaping their global trade relationships, finding completely new avenues for their goods. It feels like a profound recalibration.
The data absolutely backs that up. If you look at January to May of this year, China's merchandise trade grew. And not just in sheer volume, but significantly in quality, too.
No quality.
Yeah. Their total goods, imports, and exports hit, wait for it, 17.94 trillion yuan. That's about 2.5 trillion US dollars.
Wow.
Which is a solid 2.5% year-on-year increase. But even more notably, their exports alone, they expanded by a really robust 7.2%. 7.2% export growth, despite all these headwinds.
Exactly. This isn't just, incremental growth you might expect. It's a clear demonstration of economic resilience, even adaptability, in the face of pretty significant external pressure.
So it's not just about the overall numbers growing. It sounds like it's fundamentally about diversified growth.
Precisely. Emerging markets are now contributing significantly more to China's overall trade picture than they ever have before.
Okay, like where?
Well, for example, trade with Belt and Road partner countries.
Yeah.
The nations involved in China's huge global infrastructure and trade initiative that rose by 4.2%.
Okay.
Exports to ASEAN, the Association of Southeast Asian Nations, so that includes places like Indonesia, Vietnam, Malaysia, they climbed a substantial 9.1%.
Nearly a 10% increase there.
Yeah. And even exports to Africa jumped by a significant 12.4%. This really highlights what China itself is calling its more diversified market landscape.
It's like they're actively building this new, broader circle of friends in the global trade arena, moving beyond their traditional partners.
That's exactly the sense you get. And look, this isn't just about finding new customers for the same old products. Many Chinese companies are genuinely adopting more globalized strategies.
No, so?
Well, they're actively targeting these emerging markets not just as alternative buyers, but as new crucial destinations for their made-in-China goods. It reflects a much deeper commercial presence, a more strategic, long-term engagement, really beyond just the U.S. or Europe.
So it signals a fundamental shift in how they're thinking about and executing their export strategy, moving away from maybe that singular reliance on Western markets.
I think that's fair to say, yes. Yeah. It's a conscious diversification.
And what's particularly striking to me is what is driving these new export figures. You mentioned quality earlier. It's not just basic goods anymore, is it?
No, definitely not. Electromechanical products now make up a massive 60% of their total exports.
60%.
60%. And that category grew by a healthy 9.3%. But if you dig deeper into that, you find genuinely high-value added products. Integrated circuits, microchips, essentially. Exports there soared by an impressive 18.9%. Electric vehicles, EVs, surged by 19%. Even ship exports rose by 18.9%.
Wow, those are big jumps in high-tech areas.
They are, and it shows this isn't just about maintaining volume. It's a clear shift towards higher value, greater technological sophistication, advanced manufacturing. It's a strategic move up the value chain, clearly.
Which makes sense if you're trying to compete globally in a tougher environment.
Absolutely.
Right.
And if we connect this to the bigger picture, this kind of sustained resilience and growth, especially in these advanced sectors, it really demonstrates China's remarkable ability to, well, move up that value chain in both manufacturing and services. This strategic progression allows them to adapt better to external pressures, like these tariffs, and also to proactively create entirely new sources of trade momentum. It's not just defense, it's offense too.
And it helps explain something really significant you mentioned earlier, that shift in trade partners.
Exactly. As of June 2025, ASEAN, that bloc of Southeast Asian nations, has actually overtaken the U.S. as China's largest trade partner.
That's a massive headline right there. ASEAN is now #1 for China.
It is. It's a huge, tangible indicator of this strategic reorientation we're talking about.
Yeah.
It really highlights the growing economic interconnectedness within Asia itself and China's, well, success in redirecting its trade flows towards the region.
Okay, so that's the macro picture, the big strategic shifts. But what does this all mean on the ground for major global companies? How are these massive changes actually happening in practice? Let's maybe zoom in on some key examples.
Good idea. Because it's at the corporate level, isn't it? In the boardrooms, on the factory floors, that's where you really see the rubber meet the road.
Definitely.
And a prime example, almost a dramatic one, is Apple. Apple's deep and, frankly, very rapid foray into India.
Ah, yes, the India story.
The figures here are genuinely astonishing. They really speak volumes about corporate strategy when faced with tariffs. Apple is now funneling almost all of its India-made iPhones directly into the U.S.
All of them.
Practically. From March to May 2025, a staggering 97% of iPhones exported from Foxconn's main Indian factories went straight to the U.S.
97%. That's up from, what, about half before?
Exactly. It's a massive, almost instantaneous jump from the 2024 average, which was just over 50%. It just shows a very rapid, very decisive strategic pivot by one of the world's biggest companies.
And the driving incentive behind that pivot seems pretty obvious, doesn't it?
Oh, absolutely clear. Tariffs.
Yeah.
India is still charged, a baseline U.S. tariff of 10%, which is significantly lower orders of magnitude, lower than the, punitive 55% duties that are imposed on Chinese-made electronics.
55 versus 10%. That's a huge difference on billions of dollars worth of product.
Huge. And interestingly, that previously proposed 26% reciprocal tariff on India, which could have complicated things, that's been suspended. So that created a much more favorable environment for Apple to make this strategic pivot. It's a clear pathway to significant cost savings.
And it's not just Foxconn, the giant, is it? Other manufacturers, too.
That's right. Beyond Foxconn, which is, a titan Apple supply chain, we also see Tata Electronics. They're a newer, comparatively smaller iPhone manufacturer in India. They're following a strikingly similar pattern. From March to April 2025, 86% of Tata's exports were directed straight to the U.S. That's up from 52% in 2024.
86%. So everyone's basically pointing their India production towards the U.S. market now.
Seems that way. And the sheer scale of this redirection is just evident in the numbers. In just the first 5 months of 2025, Foxconn shipped, get this, $4.4 billion worth of iPhones from India to the U.S.
$4.4 billion already.
That figure alone exceeds the $3.7 billion total for all of 2024.
Wow. That really underscores the speed and the volume of this supply chain realignment. It's happening fast.
Incredibly fast. And this isn't just, a casual shift in logistics. It involves incredible, almost Herculean efforts on Apple's part.
Like what?
Well, apparently, Apple has actually leased entire planes specifically to transport iPhones straight from India to the United States.
Leasing planes just for iPhones.
Yes. Dispatching something like $2 billion worth of iPhone 13s, 14s, 16s, and 16 devices in March alone on these leased planes. Think about that logistical feat.
That's incredible commitment.
It is. And they've also reportedly pressured Indian airport officials, specifically at Chennai International Airport, to dramatically reduce customs clearance times from what was apparently an arduous 30 hours down to just 6 hours.
30 down to 6. That shows how deeply invested they are in making India work as a major manufacturing hub, smoothing out those logistical bumps.
Exactly. But despite this really impressive ramp-up and, the clear political will in India, Prime Minister Modi is personally pushing to make India a global smartphone production hub. It's important we acknowledge that India's manufacturing ecosystem, it still faces its own inherent challenges.
Like what specifically?
Well, for one, high import duties on crucial components. That still makes manufacturing in India actually more expensive compared to some competitors like China, for example. That's a hurdle they still need to overcome.
So it's not a perfect solution yet.
Not perfect, no. But analysts remain remarkably optimistic. Counterpoint Research, they're a leading industry tracker. They expect made-in-India iPhones to account for a really significant chunk, 25% to 30% of global iPhone shipments in 2025.
25 to 30% globally. That's up from, what, 18% last year?
Correct. Up from 18% in 2024. So this doesn't look like just a temporary workaround, does it? It looks more like a fundamental re-architecture of their global production.
Yeah, a major shift. And even with this really strategic corporate move, it hasn't exactly been quiet politically, has it? Particularly from the U.S. side.
No, it hasn't. It's drawn criticism, particularly from figures like Donald Trump. He publicly stated, and I think this is a direct quote, "We are not interested in you building in India. We want you to build here."
Right. That underscores those broader, often protectionist political pressures at play in the U.S., doesn't it? Even when companies are clearly just trying to navigate these complex international tariff landscapes to stay competitive.
It's that constant push and pull, isn't it, between corporate strategy trying to optimize globally and nationalistic economic policy trying to pull things back home.
Yeah.
And this whole scenario with Apple in India, it really raises a truly important question, I think. Is this type of large-scale corporate move purely a strategic sidestep around tariffs? Just finding the cheapest way?
Or something more.
Or is it something more profound? Maybe a broader warning shot in the global reshaping of technology production? It seems driven by a prioritization of resilience, maybe supply chain sovereignty.
Future-proofing, maybe?
Exactly. Future-proofing against unpredictable policy uncertainty, rather than just chasing the absolute lowest possible cost or the fastest speed to market, like maybe they did in the past.
So it suggests a fundamental, maybe long-term shift in how these global tech giants are approaching where and how they manufacture their products, moving beyond just pure economic efficiency towards perhaps strategic geopolitical alignment.
I think that's a very plausible interpretation, yes. It looks like a deeper strategic shift.
Okay, so India is a huge part of this story. But it's not just India, right, that's experiencing these direct pressures and becoming this crucial link in the new supply chains. Southeast Asia, and especially Vietnam, seems right in the thick of it, too.
Absolutely. Vietnam is feeling the heat from, well, both sides of this trade conflict.
How so?
Well, the U.S. is explicitly urging Vietnam, pressuring them really to reduce its dependence on Chinese high-tech components, specifically in electronics and other high-tech devices that are assembled within Vietnam's borders but then exported to America.
So the U.S. is looking inside the Vietnamese factory and saying, too much Chinese stuff in here.
Essentially, yes. It's a very pointed request,
Right.
specifically designed to reduce the Chinese content in products that are ultimately destined for the U.S. market. It's a clear effort to try and decouple those supply chains, at least partially.
And there's a stick involved, too, isn't there? A potential consequence if Vietnam doesn't meet these targets.
A very big stick, yes. Vietnam faces the looming threat of significant U.S. tariffs, potentially reaching as high as 46%.
46%.
Yes, starting possibly as early as July 8th. That's a huge economic threat for an export-oriented economy like Vietnam, which relies heavily on access to the American market. It could severely cripple their manufacturing sector if imposed.
And which products are we mainly talking about here?
This concern primarily centers on key exports like smartphones, virtual reality headsets, things that are increasingly being manufactured in Vietnam.
Right. But the issue is they still rely heavily on Chinese components for those products.
That's the core challenge. While major American tech giants, Apple, Samsung, Meta, Google, they all operate substantial production facilities in Vietnam now. Their Vietnamese contractors remain deeply, almost inextricably dependent on these Chinese components.
Can't they just switch to Vietnamese suppliers?
Well, the Vietnamese Ministry of Trade is actively encouraging local companies to use more Vietnamese components.
Yeah.
But the reality is their domestic supply chain, their cost structure, it's estimated to be maybe 15 to 20 years behind their Chinese competitors.
15 to 20 years. That's a huge gap.
It's an immense gap. And it makes a rapid decoupling, like the U.S. is advocating for, incredibly challenging. Realistically, it seems unlikely in the short to medium term. They just don't have the domestic capacity or cost effectiveness yet.
And this pressure, this difficulty in decoupling, leads to this other fascinating, maybe somewhat controversial practice, the relabeling issue.
Yes, the relabeling. This is coming to sharp focus. Vietnam reportedly shipped something like $33 billion worth of tech products that were effectively relabeled as made in Vietnam.
$33 billion worth.
Yes, in what appears to be a direct effort to bypass U.S. tariffs that would have applied if they were labeled made in China.
So goods essentially made in China, maybe with some final assembly in Vietnam, getting a new label to avoid tariff.
That seems to be the allegation, yes. And Vietnamese officials have openly acknowledged this is an issue. They say they're intensifying controls to try and prevent it, but it really shows the lengths companies, maybe even nations, are going to navigate or perhaps circumvent these ever-rising tariff walls.
It's a cat and mouse game.
It really is. And what's truly fascinating here, I think, is seeing how Vietnam is navigating this incredibly delicate, high-wire balance. They are caught squarely between the demands of their largest trading partner, which is China. Remember, China accounted for about 26% of Vietnam's total trade volume in 2024.
26%, that's huge.
Huge. And on the other side, the looming threat of potentially crippling U.S. tariffs. This complex dynamic means that a rapid decoupling from China, like the U.S. wants, it's not just difficult, it's highly unlikely.
They can't afford to alienate either side completely.
Exactly. Vietnam needs to find a way to maintain its economic stability, protect its burgeoning manufacturing sector, and somehow avoid alienating either of these economic superpowers. It requires a real masterclass in strategic diplomacy and economic resilience.
Okay, so these rerouting strategies, whether it's through India or Vietnam, they clearly have this profound ripple effect, don't they? It's leading to market dynamics that seem like they could be both an opportunity and a significant challenge for the entire Southeast Asian region.
That's absolutely right. It's not just about what individual companies like Apple are doing. It's about how entire regional markets are being fundamentally reconfigured, potentially flooded with goods, and certainly put under strain.
Flooded, you mean by Chinese goods looking for a new home?
Precisely. There are growing, tangible fears within ASEAN about what some economists are now explicitly calling a second China shock.
A second China shock. What does that mean exactly?
Well, it's not just abstract concern. It's driven by very real anxieties over China's industrial overcapacity, their ability to produce way more than they consume domestically, and also, crucially, technological dependence on China, particularly in key high-growth sectors.
Like what kind of sectors?
Things like solar panels, mechanical engineering components,
Okay.
and the rapidly expanding e-mobility sector, electric vehicles, batteries, charging infrastructure, all of that. China has massive capacity in these areas.
And the fear is that this overcapacity leads to dumping.
That's the prediction. The predicted consequence is quite stark. China's persistent ability to produce goods far beyond its domestic needs is likely to, well, flood global markets, including key economies like Indonesia and other Southeast Asian nations with these surplus goods.
Creating a new China shock.
Exactly. This massive influx could fundamentally alter market dynamics across the region. It could potentially undercut local industries, making it very, very difficult for domestic producers in places like Indonesia or Malaysia or Thailand to compete on price.
So let's look at Indonesia specifically then. How are they positioned in this complex landscape?
Well, Indonesia benefits from a certain degree of flexibility, perhaps more than some of its neighbors. Its exports to the U.S. account for less than 10% of its total shipments.
Only 10%. That's relatively low compared to, say, Vietnam, maybe.
Yes, much lower than some ASEAN peers who are far more reliant on the U.S. as their primary export destination. This gives Indonesia more room to maneuver, more flexibility to diversify its markets. They have a slightly stronger hand to play in this global chess game, perhaps?
And they have some experience with this, right? From what people are calling Tariff War 1.0.
They do. We can recall some valuable lessons from back during President Trump's previous term. During that period, China successfully sidestepped many U.S. tariffs by, well, ingeniously rerouting exports through third countries. Mexico was one, and various Asian nations were key.
And Indonesia actually benefited from that, didn't they?
Surprisingly, yes, Indonesia benefited as some of its products managed to supplant Chinese goods in the U.S. market. And maybe even more significantly, they saw a notable influx of export-oriented Chinese foreign direct investment, or FDI. Chinese companies basically set up shop in Indonesia partly to serve the U.S. market from there.
Okay, but the implications for Tariff War 2.0, this new round, might be quite different.
They might indeed. While Indonesia benefited passively before, the current environment could actually see that previous influx of Chinese investment into Indonesia begin to slow down. Well, if the U.S. is getting stricter about rules of origin, or if the overall environment just feels too risky, that investment might dry up. Furthermore, Indonesia's own domestic market now faces significant uncertainty because of that potential market flooding from China's overcapacity we just talked about.
So they can't just expect to benefit passively this time.
No, this scenario requires a much more nuanced, proactive, and frankly defensive approach from Indonesia. They need a clear strategy.
And it sounds like they're developing one. They're not just sitting idly by.
No, they seem to be actively taking a range of proactive measures. On the defensive side, for instance, they're looking to significantly strengthen their trade defense mechanisms and remedies.
What does that mean in practice?
Things like anti-dumping investigations, countervailing duties, basically tools to protect their domestic industries if they face a surge of unfairly priced or subsidized imports. They're anticipating a potential surge of dumping and illegal imports and getting ready.
Okay, that's defense. What about offense?
Quite smartly, they're also pursuing an offensive strategy. This includes proactively engaging in bilateral negotiations directly with the United States. They're mirroring strategic moves we've seen from other ASEAN members.
Talking directly to the U.S.
Yes. And crucially, they seem to be refraining from retaliating with tariffs of their own. They likely recognize that a tit-for-tat trade war would probably harm their own economy more in the long run.
Smart. What else?
They're also undertaking a critical review of their own non-tariff measures, things like their own import duties, complex regulations, bureaucratic barriers.
Things that might annoy the U.S. or other trading partners.
Exactly. They're reviewing these with an eye toward improving American perceptions, maybe addressing any asymmetric liberalization effects, making sure trade is fair in both directions. It shows a pretty sophisticated diplomatic and economic effort to manage the situation.
That sounds quite comprehensive. Are they also trying to position themselves within these new supply chains?
Yes, absolutely. Strategically integrating themselves more deeply. They're positioning themselves to supply goods that can maybe complement exports from those heavily tariffed nations like China, aiming to capture new opportunities that arise as these global supply chains get reconfigured.
So maybe making components that used to be made in China.
Potentially.
Mm.
And to diversify their foreign investment sources, they're working diligently to attract FDI specifically into intermediate goods manufacturing, making the components and parts needed for finished products. And they're targeting countries that face lower U.S. tariffs, like Japan, for example.
Trying to get Japanese companies to set up component factories in Indonesia. That's clever. Moving up the value chain.
Precisely. And internally, they're focusing heavily on upgrading their own logistics and industrial infrastructure.
Yeah.
This isn't just about moving goods around more efficiently inside Indonesia.
It's about competitiveness.
Exactly. It's aimed at enhancing their broad competitiveness across the board. And a key goal here is to ensure that any re-export of foreign origin goods that might come from China, get processed in Indonesia, then sent on, satisfies those stringent rules of origin requirements.
Making sure it counts as made in Indonesia legitimately.
Ensuring there are substantial value additions happening in Indonesia, not just goods passing through in transit. This prevents their role being just a transit point and helps them secure their position as a genuine manufacturing and assembly hub.
It seems like a very strategic adaptation.
It does, and it really raises an important question, doesn't it, about how economies like Indonesia can strategically adapt to these protectionist measures. It seems to be about strengthening their internal resilience, diversifying partnerships, building genuine economic capacity, and having strategic foresight, rather than just being solely reactive to whatever external pressures come along.
Looking beyond just Indonesia at the broader ASEAN implications, you mentioned earlier that ASEAN has overtaken the U.S. as China's largest trade partner as of June 2025. That's a truly significant, almost tectonic shift, isn't it?
It really is. It's a massive reorientation of global trade flows, signaling a clear shift in economic gravity towards Asia.
And this shift, it must be spurring coordinated regional responses within ASEAN.
It certainly seems to be. Indonesia, for example, as we discussed, has accelerated the signing of various bilateral and regional trade agreements, like ASEAN Plus 3 and the Monumental Regional Comprehensive Economic Partnership, or RCEP.
RCEP, remind us what that is again.
RCEP is the world's largest free trade agreement. It covers nearly a third of the global economy, including China, Japan, South Korea, Australia, New Zealand, and all 10 ASEAN states.
Wow. So these agreements are designed to...
They're designed precisely to diversify export destinations for ASEAN members, and crucially, to bolster supply chain resilience across the region, creating a more integrated, more robust regional trading bloc that can hopefully better withstand external shocks like U.S.-China trade tensions.
And are we seeing other regional dynamics, maybe infrastructure projects that play into this?
Yes, definitely.
Right.
Take, for instance, the East Coast Rail Link, the ECRL, in Malaysia. This is a massive infrastructure project, a railway stretching right across the Malaysian peninsula.
Okay.
It's poised to boost Malaysia's economy significantly and greatly enhance connectivity, not just domestically, but regionally. It could potentially facilitate even more diversified trade flows across Southeast Asia, creating new logistical pathways that further support this regional reorientation of trade. It connects ports on the east and west coasts, potentially bypassing busier shipping lanes.
So another piece of the puzzle facilitating this shift towards regional integration.
Exactly. And if we connect all this to the bigger picture, ASEAN is truly emerging as a critical nexus in this global supply chain reshuffling. They're not just functioning as a passive conduit for goods trying to bypass tariffs, as maybe some initially perceived.
They're becoming more active players?
I think so. They seem to be evolving into a significant economic bloc in their own right, one that's actively influencing global trade flows and investment patterns through strategic policy, like those trade agreements, and through infrastructure development, like the ECRL. Their strategic responses and this increased internal integration really highlight their growing importance and resilience in this new, more fragmented global trade landscape.
Okay, so beyond the immediate trade flows, the rerouting strategies, the regional impacts, these escalating tensions must be sending wider tremors through the global economy, right? And reshaping geopolitical alignments, too.
Oh, absolutely. The ripple effect extends far beyond just goods moving from A to B via C. It's definitely affecting capital flows, technology development, and fundamental power dynamics.
How are we seeing that play out in financial markets, for example?
Well, that's a crucial indicator. We're seeing a direct global economic impact. Global IPO activity, that's initial public offerings. When companies go public, it slumped significantly in 2025.
And that's linked to the trade tensions.
Directly linked, according to many analysts. These escalating tariffs, the sheer market volatility they create, make it a much riskier environment for companies to go public. This instability is clearly deterring new offerings and sort of stifling capital formation globally.
And how are investors reacting to this volatility? Where's the money going?
We're seeing a tangible shift in investor behavior. Reports suggest U.S. investors are redirecting capital back home, looking for the relative safety, maybe, of domestic markets.
Bringing money back to the U.S.?
Yes. And at the same time, other global investors are actively seeking out lower tariff jurisdictions for their investments, essentially looking for havens where their capital isn't immediately penalized by these trade barriers. Everyone's searching for stability and more predictable returns in what feels like an increasingly choppy environment.
And this redirection of capital, does it fuel that debate about the future of the U.S. dollar?
It absolutely does. It leads into that truly fascinating and critical debate. The question is being raised, quite seriously, whether the U.S. dollar's decline as the world's preeminent reserve currency is, in fact, inevitable.
Because of the tariffs?
Partly. Some argue that recent Trump administration actions, particularly the aggressive use of tariffs and the uncertainty it creates, are perceived to have actually harmed the dollar's long-term stability and, maybe inadvertently, handed China a golden opportunity to bolster its own currency, the renminbi, or to develop alternative financial systems.
It's fascinating how trade policy ripples through finance.
Isn't it? What's truly fascinating here is how these seemingly narrow trade policy decisions can ripple through the entire global financial ecosystem, influencing everything from where investments flow to the very stability and status of global reserve currencies like the dollar. It just speaks to the deep, almost inseparable interconnectedness of trade, finance, and geopolitics.
And China, presumably, isn't just watching this happen. They have their own strategies.
Oh, definitely not just watching. They're implementing their own proactive hedging strategies. We've seen them significantly cut their stockpiles of U.S. Treasury bonds.
Selling off U.S. debt.
Exactly. They've cut their holdings to a 16-year low, apparently, amid this ongoing trade war. U.S. Treasuries are essentially debt issued by the U.S. government, traditionally seen as a super safe investment. China reducing its holdings looks like a very calculated move.
To achieve what?
Probably to reduce its exposure to the U.S. financial system, hedging against potential future U.S. sanctions or further economic pressures, and perhaps also diversifying its own reserves into other assets or currencies. It's risk management on a massive scale.
Okay, so that's the financial side. What about technology? The outline mentioned China's push for self-reliance there, too.
Yes, and beyond finance, China is making truly significant strides in technological self-reliance, while also strategically expanding its global technological reach.
We've seen headlines about Huawei, for instance.
Exactly. We've seen compelling evidence of China's advancements. Huawei's cutting-edge AI chips, for example, have demonstrated capabilities to even outperform chips from NVIDIA, a global leader in AI hardware, in running certain specific AI models.
Really? Outperforming NVIDIA?
In certain tasks, yes. This clearly illustrates China's remarkable progress in, well, overcoming U.S. tech control measures, like export bans on advanced chips, and significantly pushing their own domestic innovation forward. It's a testament to their focused investment in R&D over many years.
It's almost ironic, isn't it? The U.S. imposes tech curbs aiming to slow China down.
And it pushes them to innovate faster domestically.
Yeah. It's noted by many analysts that these curbs are inadvertently pushing China to innovate even more aggressively at home. This pressure, in a strange twist, could be leading to entirely new breakthroughs within China itself, fostering greater self-sufficiency and resilience rather than the dependence the U.S. perhaps hoped for.
It's a classic case of pressure fostering innovation, isn't it?
Yeah.
That's certainly one powerful perspective. And furthermore, China is actively building alternative financial infrastructure designed specifically to circumvent the Western-dominated systems like SWIFT.
Like their own payment system.
Exactly. Their cross-border payment system, CIPS, is rapidly spreading across Africa and Asia, We're seeing uptake in Central Asia, the Gulf states. This serves as a critical strategic hedge against potential future U.S. sanctions. It creates independent channels for financial transactions that don't rely on the dollar or Western banking network.
Building parallel systems.
Essentially, yes. And we're also seeing their broader industrial influence growing in other ways. There are what some analysts are calling U.S. Trojan horse alarms, concerns about China's advanced industrial robots making their way into European factories, for example, indicating a wider market expansion and future industrial penetration beyond just traditional trade routes.
So advanced manufacturing capabilities spreading globally.
Yes. And all of this, taken together, it really raises that profound and important question about the long-term effectiveness of protectionist measures like tariffs and tech controls.
Do they actually work?
Well, do they ultimately hinder the target country's progress in the long run? Or do they inadvertently accelerate that country's drive for self-sufficiency, pushing them to develop alternative global systems, maybe even creating a more multipolar world faster than would have happened otherwise?
That's the multi-billion-dollar question, isn't it?
It really is. It's a complex, ongoing strategic chess match, and the implications will likely play out for decades to come.
Well, we've certainly taken a deep dive today into this incredibly complex, rapidly evolving landscape of global trade. We've seen how these geopolitical tensions are spurring really unprecedented shifts in supply chains, in fundamental economic strategies, from that relentless pressure of U.S. tariffs to China's incredibly resourceful rerouting of exports through crucial regions like India and Southeast Asia. We've explored the significant challenges, but also the surprising opportunities this presents for those regions.
Yeah, and we also touched upon those broader, profound implications for global economics, for technological development, and even for the very architecture of international relations going forward.
Absolutely. It's clear this isn't merely a story about tariffs and trade deficits, is it?
Not at all. It's about the fundamental reshaping of global production. It's about the new prioritization of supply chain resilience. It's about the pursuit of economic sovereignty in a world that's still incredibly interconnected, yet also becoming much more strategically fragmented.
The forces we've discussed today, they really feel like they're laying the groundwork for a completely new era of global trade. One that's going to look very different, I suspect, from the one we've known for the past few decades.
I think you're absolutely right. The landscape is shifting beneath our feet.